Happy Sunday, everyone. In this video, we're going to do a deep dive into the stock volatility box trades from Friday, May 1st, 2020, once again via our volatility box live scanner. We did the same exercise last weekend as well, where we looked at April 24th's activity. So we'll repeat the same thing, except this time we're going to look at the data a little bit differently. So last time we focused on sectors and we looked at classifying all of the stocks into 4 sectors. This time we're going to look at taking the trades as they are, and this time trying to find patterns inside of the model. So things like what was aggressive versus conservative, things like what time of hour was really good for the trade, things like was volume a good indicator of what might be a winning percentage or a losing percentage, things of that sort. So I think it's a fairly interesting episode. Keep in mind, most of this data is manually gathered. And so for those of you that are requesting that this happens more frequently, I'm working on it, but this takes a good amount of time every weekend to build this report. So on Friday, we had a total of 68 trades that hit our live scanner. And this live scanner is our volatility box triggers page, where it goes and tells us everywhere where price is currently breaching our volatility box lines. So we've outsourced that to the machine, and using that, out of all the stocks we look at, there were 68 that hit our threshold of being at least $10 or more, trading at least 1 million shares or more. And that's our base sort of liquidity criteria, if you will. And out of those 68 trades, we had a total of 29 of them that actually triggered according to our rules, and those rules are the volatility box fade rules. That's where price hits our volatility box clouds, which I'll show you in just a second, and then we get our confirmation signal using the edge signal indicator on a 1-minute time frame. Once that happens, the trade is set, the trade is active, the trade is live, and our entry, stop, and targets are all predetermined using levels that we have ahead of time. So in this video, we'll deep dive into those 29 trades. And before we continue, I think there's also one interesting thing to call out, which is we had two behemoths that came onto our volatility box dashboard on Friday, both for their respective reasons. So one was AMZN, which my guess is related to market volatility. It was a volatile day on Friday. We did have a breach in AMZN, and AMZN ended up hitting its target beautifully for a good $21 or so, but we did not get the edge signal there. So if you're waiting for a confirmation signal, no trade there. The second was about Tesla, which I think everyone is now well aware of what happened on Friday. But just in case you're watching this video in the future, Elon Musk came out and tweeted that he thought his stock price was too high, which then caused the stock price to plummet. And as that happened, Tesla hit our volatility box levels. We hit our aggressive levels only, not the conservative ones, which would have been, I think, the more interesting trade where we would have gotten that edge signal. But off of the aggressive, no edge signal, so no trade. Now, just as a reminder, for those of you, there's two different ways to plot these volatility box levels. The first, most convenient, fastest, and easiest way is using the dashboard, and that's where you can put in up to 30 tickers, and you can get these levels predetermined ahead of time, where you have your long entry, your stop, and your targets, and same with the short side. Right, so whenever trades trigger off of the triggers page, which is our live scanner, you can then go ahead and add them to your dashboard where you have all these levels where you can trade. Conversely, if you're much more visual, then you may prefer to use the actual Thinkorswim charts where you can take these same exact levels, plot them here where you now have clouds on the upper side as well as the lower side, which are your same long and short zones. So that's what the actual trade basis looks like. Now let's do a deep dive into the actual trades. So we'll start by looking at aggressive versus conservative. Now, with aggressive, we had a total of 15 trades that set up using the aggressive long. We had a total of 8 that set up using the short. And the winning percentage on both of these was, well, 50 or higher. The longs were particularly nice, obviously, because they triggered a lot more. We also had a nicer winning percentage with a 73% win rate. And I have the P&L included here, but really for the purposes of this conversation, I want to focus more on the winning percentage because that does a better job of really comparing apples to apples, right? A P&L of, say, AMZN included in this might skew, say, aggressive long one way because the dollar amount is a lot greater, but that doesn't necessarily represent what the truth is. And so that's where I think the winning percentage is just a better predictor of what we want to focus at for right now. So the aggressive setups worked pretty well. Now, if we take a look at the conservative setups, that was a different story, right? We had a total of 5 trades, 3 on the long, 2 on the short, but all 5 of those were losers. So obviously my next question is, well, what the heck happened there? So we're going to dive a little bit deeper there. So let's take a look. Now, in the longs, particularly, we had 3 longs that set up. We had FLR, we had INSG, and we had OIH. all three of these happen to be around the same time, right? 8:46 to 8:50 a.m. Pacific. And this is approaching that lunchtime hour in the New York time. So that's the key to kind of keep in the back of your mind. If you look at the shorts, very similar as well, right? Right around that same time. So this is 12 noon East Coast time where folks are starting to take lunch. You see a little bit more funky volatility. And with it being a Friday, I think that adds on to it, right? So now if we kind of break that down, we see very clearly that the losses for the conservative side came really within a span of that 1.5 hours where all the folks go for lunch on a Friday. Now, the next layer or dimension that we'll compare these trades to is using volume. So now with volume, we have this categorized into a few different sections. We have any shares between 1 and 5 million, 5 to 10 million, 10 to 20 million, and then 80 million plus. And this isn't at the time of entry. This is using a 50-day average, so we have a better predictor of, well, what's the general volume like, and can we expect to see liquidity in here? So now using the 1 to 5 million, you see sort of what you expect where most stocks fall in that range. We had a total of 25 trades there with 60% of them being winners. However, now if you start to go down a little bit deeper, in the 5 to 10 million, you only had one trade, which was a winner, but the 10 to 20 million range had two trades, both of which were losers, and both of which were in OIH. One was an aggressive, one was a conservative. And then in the 80 million plus category, you only had one trade, and that was in USO. So to me, the obvious observation here is oil stocks are currently moving erratically. Go figure, we all know that. But that also translates to using these setups on the volatility box or whatever other trending setups you may have. Just trying to fade this price action isn't necessarily working right now. So if you are looking at a setup, the trending ones, are the ones that you may want to focus on because that's where you can actually ride some of these moves where price isn't really respecting our levels. And so using deductive reasoning, we can then say that, okay, using our trend trade where we have our squeeze signal as our entry, we're actually hitting the gray target lines as well as the clouds, as well as blowing through those clouds. And so you know that the idea of a stretch target is much, much more likely in some of these oil stocks on trending plays. So that's a key takeaway there. And now if we take this one step further, which is we start to categorize all the stocks that came and we see how many of them fit into these four different buckets. And now if we dive deeper into these markets, we'll start with the S&P 500, but the S&P 500 had a positive P&L along with a positive winning percentage. Same with the NASDAQ. However, if you then take a look at the Russell, you see that the Russell starts to become negative in both the aggressive longs and shorts along with the conservative long. And so I thought that was fairly interesting, right? So now if we use again, what's the takeaway here? We had a positive winning percentage in the S&P 500 and NASDAQ, but a negative one in the Russell. So now if we tie this back again to another obvious observation, so let's look at the charts on a broader scale. And if you take a look at the S&P 500, the NASDAQ, the Dow, and the Russell, and you compare all of them, it should be fairly obvious that the Russell is the weakest of the charts. I don't care which indicator set you're using, but that for the most part has been the weakest. And we talked about this in a previous video where we even did a global comparison where the Russell falls almost as much as some of the larger ETF sectors representing actual countries. So point being, Russell has been weak. And we see that weakness translating also with a lower winning percentage using the volatility box. And I'm assuming whatever other setups you may be using where you're trying to fade that price action, where really right now you're seeing just unpredictability, a good amount of volatility, and there's other markets that are giving us a higher winning percentage. So let's boil all that down into three takeaways to wrap this video up. And again, these are just three simple takeaways. You can find your own, but the first is be strategic in how you're approaching trading on Friday. You've heard this a million times, but this is more proof, which is don't let Friday afternoons ruin your week's gains or exacerbate the losses if you've not had such a good week, right? That has the potential, the Friday afternoon, to basically change the rest of your week, set you into the weekend, and change your entire mentality come Monday. So you'd like to have a winning mentality headed into the weekend, and part of that is knowing when to take your foot off the pedal and knowing when, hey, I shouldn't be trading. So Friday afternoons are one of those categories for me. Friday afternoons, East Coast time onward. So that's really 9 a.m. And we already saw that, right? We saw 8 a.m. really onwards. The probabilities, the winning percentage starts to go down a little bit. The second is we focus on liquid candidates with weighting in the larger markets. That's where the S&P 500, the NASDAQ, the 1 to 5 million shares, along with the higher volume shares, have all been fairly profitable for us. And so focusing on those seems to be a smarter idea, at least right now while we have the current volatility that's going on. The second takeaway here is the conservative volatility box doesn't always lead to a higher winning percentage. You would think it does, but we saw, at least on this Friday, The aggressive setups were the ones that actually gave us a higher winning percentage, a higher P&L, and let you take some profits out of the marketplace, versus if you had focused on just the conservative. So I thought that was fairly interesting. And then finally, we have avoid oil stocks such as OIH or USO if you're looking at fading them. But if you are looking at trend trading, that's where you can use the volatility box as targets instead of places where you'd like to enter the trade, and use something like the squeeze signal to help you enter the trade instead. But really, the gist of this is in all of the oil stocks and natural gas, we've seen this in NG as well, even with the futures markets, there's a lot of uncertainty in all of these markets right now. That uncertainty is leading to unpredictability, which is becoming harder to trade. So one way is to just focus on the places that are easier to trade. There's no reason to try and force a trade, and so that's where I think you have the luxury of, at least we had 29 opportunities, 68 total if you are looking at your own confirmation signal if you don't like the edge signal, but for us 29 were valid triggers. All right, I hope this breakdown helped, and looking at all of these stock candidates using a more data-driven approach to try and find patterns, to try and find both the winners and the losers, what's working, what's not working, to continuously improve our strategy and continuously keep taking profits out of the marketplace. Hope you all have a wonderful close to the weekend and a great week ahead. Good luck trading.